7 Rules of Investing. There are rules to follow in anything that you want to do, and it is important to know them so that you do not make a mistake. Investment also has its own rules that you should follow. Tune in. All you have to do is hit the thumbs up button, subscribe to this channel, then click on the bell notification button so that you will be informed every time I make an upload. Let us get back to the video. Here are the 7 rules of investing. Number 1. Understand the object of your investment. You need to invest in things that you understand. This does not mean that you only have to invest in the ventures in the area of expertise. You need to get information on how an investment works. It is essential to understand the business models of the companies you want to invest in to determine if the investment you want to make is worthwhile or not. I will give you 7 rules to follow when you want to invest. Number 2. Invest long-term. Always invest with the long-term future in mind. Investors focused on short-term profits are likely to lose out, especially when there are high fluctuations in the exchange rates. Investing in the short run makes you be at risk of making losses. Always invest in the assets that you want to keep in the long term because those are the ones that will make you earn more. The longer the investment horizon, the greater the potential compound interest on the initial value of the investment. Number 3. Always pay attention to valuations. Valuation is a key figure that is important to investors. A company or business valuation will give you information on whether a particular investment is lucrative or not. But how can you value a given company? Well, you may use detailed financial figures to calculate the value of the listed companies by looking at how the company has progressed in recent years. Such information can help you derive a realistic forecast of the future performance of the company. Valuation is a direct indicator with regards to how much an investor should put in a given company. Number 4. Pay attention to timing and position size. The process of investment needs time. You need to know the best time to invest in making more returns in the process. Sometimes the best time to invest may be right there and then, but sometimes you may have to wait for months or years for the right time to invest in a given venture. Do not always jump into the next opportunity before doing due diligence and determining whether a given investment is worthwhile. Number 5. Calculate the real return. The return is the decisive figure that will inform whether an investment is lucrative or not. What is the real return? Well, it is a return adjusted for transaction cost, inflation, and taxes. Do not always focus on the nominal return, which may confuse because only the real return will express increased purchase power without alteration. Never underestimate how quickly currency can lose its value in a span of years. Tax effects and transaction costs have to be included in the calculation of direct costs because they reduce the returns on investment. Number 6. Don't trust trends. Never follow the masses when you want to invest. When the worthwhile investor gives his opinion, the venture in question may have a lower profit margin. Warren Buffett said, "Always be nervous when others are greedy, and greedy when others are nervous." An investor should be able to do his calculations and make the best investment decisions in the market. Psychological effects play an essential role in financial markets. Always exercise caution when the market is booming because it may be a bubble that will burst later. On the other hand, you should not panic during a crisis. Instead, it is essential to assess the investment opportunities that are available at that moment. A successful investor should make a careful assessment of the market instead of blindly following the market trends. Number 7. Diversify risks. Successful investors should learn to invest in many assets as a way of spreading the portfolio of risk. Diversification of risks will minimize the losses when some of the risks occur affecting the investments. Diversification is an investment strategy that reduces the risk of the entire portfolio. For instance, you should not invest all your money in the shares of a given company because you could be in trouble if the company goes under. Invest in several ventures so that you will still have investment left during a crisis, and not everything will be lost. Now you know the rules of investment. Please follow them to the later if you have to succeed as an investor. Do you want to get such videos in the future? All you have to do is hit the thumbs up button, subscribe to this channel, then click on the bell notification button so that you will be informed every time I make an upload. Thanks for watching.